the recording started. All right, welcome everybody. We've got a familiar face on today with us, Ryan, who you might recognize from our recent monthly meeting, went over the Spartan portfolio and state of the union, in what was actually a very well produced episode. So great job on that. We had a lot of feedback on the quality of the presentation too. So today we've got Ryan on with us, and Ryan is going to join us and go over some due diligence. So we're going to talk about underwriting today. We're going to talk about how to read files, what to look for in due diligence, why it's important, and dive into Spartan's 670-point due diligence checklist, talking about as well as different types of projects, ground up development, and buying existing assets. So if
a lot.
We're going to go through each one of those 670 points. Is that right?
Yeah. There's 670 slides we got to go through today. So
perfect. We better get started.
I hope you get your coffee. No, I'm just joking. It'll be very informative, but high level. So
sounds good. Sounds good. Well, we will go ahead and kick it off to you, Ryan. We'll open it up for Q&A. So as we do usually, we will use the Q&A. So on the bottom left-hand corner, you should be able to see your Q&A option. Feel free to throw them in the Q&A during the call. And when Ryan's done with his presentation, we'll open it up for Q&A. I'll moderate. So again, feel free to throw questions in the Q&A. We'll get to them at the end. Otherwise, we've got a lot to get to. So Ryan, with that, I'll throw it over to you.
All right. Sounds good. Appreciate it, Ryan.
You bet.
All right. Well, thanks for joining. I'll go ahead and get right into it. Ryan gave me a nice introduction. But my name is Ryan Gibson. I'm from Spartan Investment Group, CIO here, and one of the co-founders. And we run Spartan Investment Group. And this is just a little bit about us. We do the whole value chain. So we're doing everything from finding the deal, finding the debt, finding the syndication, or raising capital from our investors or left fielders. Then we do the construction, asset management, and property management. So our perspective and due diligence is full cycle in what we do. And just a little bit about us. Fourth fastest privately held growing real estate company in the United States is ranked by Inc. 500. And we're based in Golden, Colorado. We also have an office here in Seattle. That's actually where I'm at today. And we're the 40th largest owner and operator of self-storage in the United States. And our Free Up Storage brand is what we put on all of our stores that Spartan owns. So you can see a little bit about where we operate. We operate in the Sun Belt region, Florida, Georgia, Tennessee, Kentucky, North Carolina, and then we also have a large concentration of properties and facilities in Texas, Colorado, and then we have a little bit in the Pacific Northwest. So Ryan mentioned we have a 700-point due diligence checklist. You can download this checklist on our website. If you're an active real estate investor, this could be really helpful. If you're a passive real estate investor and you're curious to learn more, these are the types of things that we talk about in our due diligence checklist. So kind of talking about our due diligence process at Spartan is we have a due diligence coordinator, someone who's going to go out and do all the physical studies, the environmental, the phase one, the survey, the title report, everything that goes into a property. She's going, Kristen Welderstadt is our due diligence coordinator, and she's getting all that together. And we're doing due diligence briefings throughout the time period that we have the property under contract. And we're basically going through this massive checklist, and everybody has due outs and assignments. Everybody from our chief legal officer, who's our in-house general counsel, all the way down to somebody at the property level who might be submitting information about what they're seeing on the ground. These are the things that we're collecting and quantifying and mitigating our risk along the way, and maybe even retrading on value for the investment. So I'm not going to go through all 700 points, but I am going to dive into kind of just some high-level underwriting things that I look for as a passive investor, but also as a chief officer of Spartan. I have a deal review this afternoon, and the things that I look for in underwriting, how I can quickly look at a deal and assess it for its strengths and weaknesses, and also really kind of get to know the business plan. So I like to open with this slide. I really like this slide. It's kind of funny. Everybody thinks they're conservative at their underwriting and a conservative investor. And today I just want to try to fine tune it so it doesn't set off the BS meter. You actually have a few things that you can take into being more conservative about the way you're looking at things, or maybe even look at things from a different perspective. This was my growth in underwriting. I don't have a big background in underwriting. I got into real estate in 2013, and I just learned as fast as I could. And I would go to a couple of conferences, and I always joke that I followed the Dunning-Kruger effect, which is on the screen, which is the less I knew, the more confident I was, and the more a top amount stupid I was. And then as I progressed in my real estate journey and made mistakes and things like that, I realized how much I didn't know. And then for the next so long, I would learn more and more and more, and then realize that I have a pretty good grasp on everything, but there's always more to learn. And I encourage you, if you're, just picking up commercial real estate or just picking up passive investing, know that there's a long journey of learning all the things that we're going to talk about. So with underwriting is basically just your financial projections on a deal. It's, you look at a deal and we say, hey, these are our best guess on how the property is going to go. And underwriting never goes the way that you forecast, but you hope that you achieve your goal of exceeding your underwriting projections. Maybe your expenses are lower, your revenue's higher, or maybe your expenses are lower, but maybe your revenue's lower, but that's okay because your expenses are a little bit lower. But you're never going to really hit the bullseye because it's impossible to project and predict every little outcome in underwriting. And I think that's important to take away is not everything's going to be dialed, but you want everything to be as close as you can or meet and exceed your goals. So like a weatherman, an underwriter, the forecast is always right until it's wrong. And it's no different underwriting. Here's the approach I take to simplifying underwriting. Because underwriting, somebody sends you an Excel file and it's got, millions of lines of numbers. And I just go, what's the, I look for some key demographic or key statistics in an underwriting file, which we'll talk about to see if it's a deal. And if I'm have to do a lot of math up front, it's probably not a deal. So I encourage you to increase your deal flow so that you can say no more often. And LFI is a great venue to do that. You've got some great partners and some great deal flow coming out of LFI. So you can increase your deal flow. You can get a better understanding of what deals you like, what deals you don't like, and which ones you want to move forward with. So I always like to say, if you're doing a lot of math, it's probably not a deal. So somebody who brings me a deal, I want to have a couple of key processes that I run it through in my head to decide if I want to keep moving on with that deal or not. And if I have to do a lot of math and really think about it, it's probably not a deal, and I'll just pass on it and move on. And I'll talk about that a little bit more. But again, increasing your deal flow, the way we did it was we hired a 5-person acquisition team. We look at about 1,200 deals a year. And in 2021, these are some of your statistics here. We purchased 45 properties out of the 1,200 that we reviewed. So we bought a lot in 2021. We bought a lot less in 2022. And we looked at a lot of opportunities to funnel them down into one. And so I encourage you as a passive investor, get your deal flow up. Go on CrowdStreet, go on Yield Street, go to LFI, attend all these events. Get your deal flow up so that you can get to know as fast as possible. So let's get into kind of like the quick math here to decide if it's a deal. So let's say you're buying a rental property. It's just a single family home and it's a $100,000 house and it produces $1,000 of rent. If somebody brought this to me, it would pass the 1% rule, which means 1% of the purchase price is the monthly income on the rent. And so some people use this 1% rule to kind of quickly assess if it's a deal for them or not. Now, of course, there's a lot of devils in the details. You got to understand what the property taxes are, the insurance, the deferred maintenance, et cetera. But you at least have an idea of if this project is going to pass what you would consider your key criteria. If the rent was $800 and your 1% rule isn't met, then maybe you'd pass on the deal and you'd keep moving on, right? Now, if you don't have a lot of deal flow, you might spend a lot of extra time on that deal and say, well, I could make it work if we did this and did that. But again, you might be wasting your time. So again, get that deal flow up so you can say no a lot more. Here's how we do it in storage. So in storage, when we're looking at ground up development, if someone brings me a deal and it doesn't have at least $15 per square foot rents, I pass on it. So somebody came to me and said, hey, Ryan, I got this raw land in this market and it's really good. I'd say, what are the rents for a 10 by 10? And if the rents aren't at least $125 per month, which if you multiply that by 12 is $1,500 a year, 1,500 bucks a year, and then divide that by the 100 square feet that we're renting, that's a $15 rent. If the rents aren't 125 for a 10 by 10 per month in that market currently, I'm a hard pass. And that number has actually gone up to about $18 rents recently. And that's because I know that no matter how awesome the deal is, I would have to basically get the land for free, or maybe they'd be paying me to take the land in order for a ground up development to work at rents that are less than $15, because I know what the construction costs are going to be at a very minimum to get a return and a yield on that asset. So that's what I do. And my, from a GP perspective, I have some quick formulas in my head and that my acquisitions team has to look at a lot of property in a very quick amount of time and get to know faster. But let's just say it passes your test. So then you start building your underwriting model, and your operator should be providing this to you so that you can look at it and have a sense of what's going on. Now, this is what our underwriting model looks like. And if you log into our deal room, you can see our underwriting model. We share it with our investors, but there's a lot going on here. So I just want to try to unpack what's happening and kind of where you can look to see some key deal points in the process. So if you notice here on this rectangular box at the bottom, that gives you a bunch of different tabs. And those tabs can really be summarized into 3 buckets: inputs, a processor, and results. So an input is things like rent roll, unit mix, assumed rental rates, interest rates, amortization schedule, lease up period, things like that. Inputs that go into the deal. So you want to understand what the operator is putting into the system, and that's your inputs. Okay, and I just kind of listed off some of the things that are inputs: unit mix tab, or assumptions on interest rate. Those are your inputs. Then you have a calculator, which is the Excel file doing its thing, that processes that information, that calculates it, and then it produces results. And so, as they say in programming, garbage in, garbage out. If you're saying, hey, I think the rents are way up here, but really they're here, it's not really going to produce an accurate result. So the data has to be as pure going in as you would expect it to be good on the way out. So so what do you need? So, when you look at an underwriting file, there's a lot that goes into it, but what do you really need to build an underwriting file? And all you would really need at the end of the day, if you went down to emergency systems only here, rent roll would be the number one thing you need. That's a roster of all your customers and what they're paying right now. That's what a rent roll is. So if you looked at a self-storage facility with 10 units, you would say, what are those 10 customers paying? And you would also note that maybe 1 or 2 of those units is empty, and that is your current rent roll. So you can then build a unit mix and know how many 10 by 10s, 5 by 10s, 10 by 20s do you have in that facility, and that would then help you start building your P&L. Now, if the seller didn't provide you a P&L, they usually do, but if they didn't have one, you could kind of build one on your own with some assumptions. But we always take the P&L and the bank statements and marry the 2 things together. So the seller provides a P&L for their business. We ask for bank statements that accompany that P&L, and then we match up the transactions and the records to make sure that P&L is accurate in bank statements. It does take a bit of time. Then what we do is we look at property tax data. We look at the county assessor's website. We see, what is this property being valued at, and what can we assume that the assessor is going to raise that property tax value to at the when we buy the property, because you're going to buy it at a higher value than the previous seller, and that may or may not be recorded with the county. Let's see, it's not, there we go. Then you want to look at your assumptions of interest rate, amortization. I talked about that. And then market data, your market study, your feasibility study is what we call it. It's in our dashboard of, hey, okay, the operator thinks they're going to get $100 rents. Their market study shows with proof based on actual market rate data that the rents in that market are $100 or greater. So that's a good assumption to make. And then you want to make sure that that's like quality property, like kind property, right? It's not a beautiful Class A building and they're buying a D class building and they're saying, oh, well, we're going to get the rents that the A class building is getting in a better location. You got to really understand your comps, and that's what goes into a feasibility study. So yeah, and you can download our checklist at spartan-investors.com. Right below the word grit, you'll see the download our 700-point due diligence checklist. So my background is an airline pilot. And, I like to say, if you look at an underwriting file, determine if the investment is airworthy, right? And that's what I did in a flight deck. That's me in the 737 getting ready for a flight. For the first hour, we basically look at the airplane and make sure that's airworthy. That's what we do. And we look at a huge flight plan and we say, okay, is the weather, is the fuel, is the destination, is the aircraft up to maintenance certification? Are there any notice to airmen or notices that we have to be aware of? And we have to do this. We have to basically grab a bunch of data and sort all through it in time for our flight to push back from the gate. And so an underwriting file is no different. You can look at an underwriting file, and within a few minutes, you can kind of just determine what the business plan is or what some assumptions are, and then if it's airworthy, if it kind of passes the sniff test with the follow-up questions that you're going to ask your operator. And this is the what I do. So this is a P&L. This is what's called an annual P&L. So if you go to the underwriting file and you click on annual P&L, this is basically giving your end of the year results from a projected standpoint. So you can look up here. Y1 means year one. Y2 is year two, et cetera, so on. And what the first thing I look at is I start from the top and I work my way down and I focus on 5 things. First thing I look at is year over year revenue growth. So when I'm looking at this, I'm going to say Y over Y or year over year revenue growth. So I look at gross operating income and I say, how much is the operator projecting that gross revenue to increase every single year, right? So in this case, I'm looking at the 339,817, and then it jumps to 448,785. And what I want to know is why. How is that operator suggesting that gross revenue is going, or gross operating income is going to go up? And that begs the business plan. I look at the experience of the operator. I look at, are they assuming the market rate rent's going up, or are they deploying some type of value add strategy in the first year that is going to net result them in more revenue, more income, or are they adding some kind of service to the property? What is causing that significant growth? And if I see more than 6%, I really want to dig in here and see how that's growing and what they're doing. And just remember, your tenants tend to move out. And then I want to know, is this realistic? Have they done other investment types where they've jumped revenue that way? And really kind of get into why the revenue is jumping so much. Now, if you're building from the ground up, we'll talk about this later, you're going to see that jump quite a bit because you're going to go from a built facility with no tenants to occupied tenants. So you're going to see that jump maybe 20, 30, 40, 50% year over year. But really kind of unpack if this is what they're assuming the market's going to go, which we all can't predict. Or is this some type of value add strategy where the operator has under market rents and they're just going to bring up the rents to market with the asset that they have? And are they carrying enough CapEx to fix up the property to do that? So that's one thing that I look at. So that's my first sort of checklist item, year over year revenue growth. The next thing I do, working my way down the spreadsheet or the P&Ls, I look at insurance. Now, whether we like it or not, the world is changing. Climate is changing. I don't know, we can debate later as to why, but at the end of the day, there's more insurance events, there's more weather events, and insurance premiums are going up. So I want to make sure that the operator got a good quote from an A-rated carrier. So that's a question that I always have. Did you get a quote, or is this an assumption? Do you have a quote from an A-rated insurance carrier? And I want to see the survey, the FEMA, make sure it's not in a FEMA flood zone. If it is or isn't, I want to make sure that it's been accounted for. It's not the end of the world if it's in a flood zone, but it's something to consider. Insurance, it's always going up every year. Doesn't matter who you are. You're not special. So if I don't see the projections showing an increase in insurance costs of usually 30% over the hold, then I'm not buying it because insurance premiums are increasing. So that's kind of my next check. And then I go down the list to property taxes. And so property taxes are another booger that's not going, they surely aren't decreasing anytime soon. So I want to see the property taxes nearly double in the hold period, because if you think about the seller is selling the asset and they probably have an assessed value of the property when they sell it. And when the transaction happens with the operator, guess what? They're probably paying more than what the seller paid for it. And so the county is going to catch wind of that. They're going to reassess your property probably 12 to 18 months after you buy it. And they're going to increase your property taxes as a result. So you can see here in this underwriting file, the operator has 18,773 in property taxes in year one, but then you can see that significant jump. So the operator is basically probably assuming here that, after year one, we're going to get reassessed and our property tax payments are going to increase by almost double. So that's something to really consider. Mill levy rate. So this is a thing, that I like to ask operators about is if you have, what is the mill levy rate, or how have you gone about your property tax assumptions? And what our team does is we look at all surrounding properties and kind of see what the assessments are for like kind properties. And then the mill levy rate is just a fancy way of saying it's like a percent of the assessed value that the county does to determine your property tax bill. So some jurisdictions, it's like 80% of the value. So let's say your property's worth $1 million. They assess it at $1 million. They're going to take maybe 80% of that. So $800,000 assessment, and then they're going to apply a percentage against that to come up with what your property tax payments are. And that's really high in some counties. For example, Fort Worth, Texas, really, really high property taxes. So you really have to make sure if you're buying in Fort Worth that you've accounted for the property taxes, and they're very aggressive on their assessments. And then the other thing too is when the property is sold, the person buying your property is going to assume that their property taxes are going to go up. So in their underwriting, they're going to decrease the value because they're going to assume their property taxes go up. So that's always something to consider as well. Moving down the list, I look at EGI, and EGI is just a fancy way of saying for every dollar that you collect in revenue, how much is it going to cost you in an expense, not including your debt. But so if you're making $1, if you spend 30 cents on that customer, you have a 30% expense to gross income ratio, or EGI. And so every asset class has sort of a sweet spot or a heuristic for EGI. So for example, if you're a self-storage operator, I want to see between 35 and 45% EGI. Now that can get more efficient as you raise revenue and sort of optimize the facility. But I want to see 35 to 45% in year one. If it's like 20% or 15%, I might ask, how have you efficiently got it that low? And I would really dig into that. So like in this example, this is a self-storage underwriting. It's at 40%. So that's okay. It's like kind of right down the middle. If it was excessively high, like 50 or 55%, the only two things you can't really control in an underwriting is your insurance and property tax expenses. Those are really things that you can't control at all. So some jurisdictions, the property taxes are very low. Sometimes they're very high. So that EGI might fluctuate based on property taxes and insurance. So that's something to really think about. And then what's standard for your asset class? We talked about that. Multifamily, the EGI, I don't know what it is. It might be closer to like 50% because expenses are higher to run a multifamily property. Likewise, if you're doing like an assisted living or some kind of medical care facility, it might be 75% because it's really expensive to run those operations. You also get a lot more revenue, but the expenses might be much, much higher, right? Because you're having to pay nurses and staff and food and cafeteria and all those things that go into running a full-time care facility versus a self-storage unit where you have empty units, you have dark boxes, right? So it's it just depends on what the EGI is, and that kind of just summarizes all of your revenue divided into your expenses. And lastly, I just say you're not special. Some operators are like, well, we can operate at a 20% EGI. Yeah, okay, maybe you can, but there might be something else going on there that is allowing you to do that, like really low property taxes, et cetera. But usually the operator is not going to be all that special to the industry averages. And then the last thing is cap rate. And I'm going to spend some time on cap rate because I love this topic. I think people get cap rate wrong all the time. They assume a low cap rate means a bad deal or a high cap rate means a good deal or whatever. We're going to kind of dive into that. But cap rate, cap rate going up or down. Listen, there's a lot of different ways to look at cap rate, and I'm going to dive into those. But when I this cap rate here, understand what this cap rate means. That's probably the step one. What does a 6.13% cap rate means? Does that mean you're taking your NOI divided by your purchase price for what you paid for it? You're going in kind of your yield to cost, or is it based on what you're assuming the market would pay, right? And in this case, this is a market-based cap rate, so this is a good, healthy, conservative market rate cap rate increasing year over year over year. So it goes from 6.13% to 6.25. So this operator is basically saying, I think your cap rate's going to get worse, which is more conservative. That's a good thing, right? If it gets better, you're assuming, hey, I'm going to buy this at a 6 cap and I'm going to sell it at a 4 cap. Okay, well, you don't know that cap rates are going to 4%. It's really hard to predict that. So a lot of their business plan might be banking on an assumption that the market's going to pay a 4 cap, right? But if the operator is saying, hey, the cap rate's going to get worse and the market conditions, it may get better, but I'm betting on it getting worse for the purposes of deriving your return results. This is a very conservative way to do that. So I like to see it increase 50 to 100 basis points now in this market. So I would say this is not conservative enough in this market that we're in with the interest rates going up and kind of uncertainty. I would say that I'd want to see it go up from like a 6.1 to like a 7, right? By the time that it's done in the whole period, a 6.5 to a 7. And that's my checklist. So I just kind of like skim this and I can say, okay, what's driving revenue? Insurance is well, well forecast. Property taxes, EJI is in line with the industry, and they're assuming they've got a good assumption for cap rate conservatism, right? So that would be kind of my checklist, right? And so I want to talk about cap rates because the cap rates are always kind of this wonky thing, and people kind of ask questions about cap rates, and I never feel like I get good questions from investors, or maybe I get good questions but not great questions from investors about cap rates. But I wanted to tell you my personal journey. So when I first invested, and we're going to cover this, what the heck is a cap rate, right? I don't even know what it was, but it's basically the underlying thing that values an investment. It's very, very important to understand. So once I kind of learned what a cap rate was, I was like, I only want to buy 8 caps, right? If it's not an 8 cap, I'm not buying it, right? And then I sort of matured my thinking a little bit more, and I was like, wait a minute, it doesn't matter what the cap rate is. You can add a ton of value and get a better yield to cost and things like that. It doesn't matter what it is because you can revert the cap rate to a better cap rate based on your purchase price if you add value to the property. And then I was like, wait a minute, how is that guy buying a 5 cap and making money? That's reckless. How does that work? But then I saw them be successful at it. And then I was like, wait a minute, there's multiple different ways to spin what cap rates are. And so now I was totally confused. So I wanted to, I'm going to unpack all those different ways to measure cap rate. And really it's trailing, pro forma, broker adjusted, reversion cap rate, cap on cost or yield to cost. A lot of different ways to do it. And so I say, let's consider all the variables of cap rate to determine the airworthiness of a deal. Let's box it in and walk through what's the trailing cap rate versus the pro forma versus the broker adjusted, the reversion, to kind of see really where the value is, right? Like we can't predict where cap rates are going to go, but we can see how the operator is going to reposition the asset to get a good yield to cost. And we're going to go through that right now. So first of all, what's a cap rate? Take the annual cash flow from a property if you paid cash. So if you're making $100,000 a year of income and you paid $1 million for it, that's a 10% cap rate. Pretty simple. Now, let's just say you're going to spend some money to fix up the property. So let's say you spend $200,000 to fix it up. And that's how you're going to achieve that same $100,000 rent. So you got to invest money into it. Well, now your cap on cost or your yield to cost is 8.3% cap rate. See, because you bought it for $1 million, but really you invested 1.2 million, not $1 million. So I like that metric better because it really shows you your cap rate on cost. So as an investor, you can buy something at a 10 cap and say, wow, this is great. It's a 10 cap. But just imagine you had to invest $1 million into it, right? And you're only going to get $100,000 of income. Your effective cap rate is 5%. So it's really important to kind of understand how cap rates can be manipulated or looked at differently to assess value. So let's just say in the same example that, the operator said, well, I'm going to buy this property for $1 million. I'm going to put $200,000 into it, and I'm going to raise rents by $100,000 a year because now I got better appliances and countertops and things like that. Well, the reversion cap rate now is 16.6% based on your cap on cost basis. So that's cool. So now my next question is prove to me that you have the ability to do that, right? And that's where your business plan comes into play. That's where the feasibility comes into play. That's where the team dynamics come into play. That's where your due diligence really lies. And so let's just say in this example, to kind of take it home, let's just say that comparable properties in that market are selling for 10% market-based cap rates. You just created $800,000 of value because if you put 1.2 in and you sell the property for $2 million because the market rate based cap rate is 10%, you've just created $800,000 in value and probably some cash flow along the way. So not a bad value proposition, assuming that everything else checks out. So again, trailing cap rates. What is a trailing cap rate? Sometimes you see this advertised as a T3 or a T6 or a T9 or a T12, right? Those are trailing cap rates. That is the actual financials of the investment going in. So if you want to know how the facility is actually performing based on what you're paying for it, you want a trailing cap rate. That is the most conservative, accurate, clear understanding of what the cap rate is going into the investment, right? and that's based on purchase price. So you look at the last 12 months and you average the income from the last 12 months. That's a T12. Some operators will say T6, or trailing 6 months, trailing 3, or trailing 1 even, right? So a lot of lenders will say, hey, what's your T1 or T3 on the asset going in? And that's what they care about for determining your DSCR and your restrictions on how much they'll lend to you, et cetera. Then you have the pro forma cap rate, right? And I joke that this is the land of milk and honey. This is what the operator is projecting the first 12 months to be. So at the end of year 1 in that annual P&L, you divide the NOI divided by the purchase price. That's going to give you, or multiplied by the purchase price. That's going to give you the pro forma cap rate first 12 months. Or you could look at 5-year pro forma cap rate, whatever, however you want to look at it. But it's a pro forma looking out a certain period of time based on the purchase price of the asset. And that's where the land of milk and honey is, because maybe not, I joke about it, but pro forma cap rate is really important, because if you are looking at a 14% return or an IRR or an equity multiple, you need to understand how they're deriving that pro forma to understand how you're going to get paid your money or your investment, the likeliness of that happening. And then you have the broker adjusted cap rate. So sometimes on a prospectus that a broker has, you're going to see something called pro forma cap rate. And this is a catch-22. And the reason why is because they might say, oh, well, the broker is going to like do all these things and, make it look great, better than it actually is. And, we all know that when you look at the deal, it's not as good as the broker suggests. That stuff all may be true, but the broker adjusted cap rate might consider things like adding in property management or taking out the expenses that the seller has that don't apply to the industry. So for example, let's just say I'm selling my self-storage facility and I like to rent a private jet and fly there once a week. Well, that's in my P&L, but the industry isn't going to fly a private jet there. So that expense might be taken out. Some broker shops don't include property management fees as part of the P&L to derive the broker adjusted cap rate. So you just got to understand kind of what goes into that, but there's a lot of catch-22s in there. And then cap on cost, I talked about that. This is my favorite place to nerd out, because this is where money is made. Your cap rate on cost, that is what your total capital infusion into that project will be, divided by the NOI day 1. That's my favorite cap rate, because that shows the value potential. So asking better questions, ask your operator, does your exit cap increase or decrease based on market conditions? Right? That's the only way to kind of see if they're being conservative. What's going in cap rate? T1 or T12, T3, T1, whatever you want to ask for. And then what's your cap on cost? What's your reversion cap rate? So if you go in at a cap on cost of 5% cap rate, and then by the end of your full deployment of value add, it's maybe that the NOI will increase to the point where your cap on cost is like a 9%. So there's a 4% value spread in there in cap on cost. And that's a good thing, right? That shows how they're going to add value to an investment. So stress testing, increasing, decreasing cap rate. What's the break-even point? That's a great question to ask. Stress test the sales price. If they can't sell it for what they're projecting, what does that do to the underwriting? Look at their lease-up rate and kind of stress test the hold period. And usually, this is, again, in your results of your underwriting, you'll see kind of a sensitivity analysis that gives you ranges based on particular outcomes. Dashboard results. I always like to make sure the operator is making money, and I want to know exactly how much they're going to make. Because while I want my operator to make money, I want them to make fees, I want them to stay motivated and aligned to finish the deal as a passive investor. So I want to understand how much they're raising, how much debt they're taking on, what my projected returns are going to be, and then I want to know what's in it for them. And again, this isn't my point to be greedy as a passive investor. I just want to make sure that they're aligned and they're not going to give up on the project, right? That they stand to make some kind of money. That's a good thing. And then also your underwriting file should spit out some type of cash flow projections for the investment. How much cash flow are you going to earn in year 1, year 2, year 3, year 4, year 5? How much profit will I make when the investment sells? And then what is the kind of the total return that you're going to get inside of that performance over 5 years? So I'm going to switch gears here a little bit. And now we're going to kind of talk about ground up deals. So ground up development, the riskiest thing you can do versus buying value add existing assets. So Spartan, we do two different funds. We do an income fund and a growth fund. And basically, when you look at the two, the income fund is we just buy value add existing properties that are producing income day one, generally 4% or more of income to the fund. If that facility doesn't cash flow right away, or there's some kind of cash drag or redevelopment strategy or lease up or ground up, we don't put it in that income fund because we know those investors are wanting the income that comes monthly from those investments. So we would put them in the growth fund. That's kind of how we would bucket things. Growth fund is all ground up development. And the first thing that you need to understand about the differences is the risk profile. So this is kind of a yield curve, and it shows you core, core plus, value add, and opportunistic. Opportunistic is the growth fund. Opportunistic is the highest return potential and the highest risk on this return risk yield curve, right? And your value add and your core plus are kind of right in the middle there is where our existing facilities fall. So not as much return, but also not as much risk. Core is like a triple net lease on a CVS on Main and Main that's never gonna go away, right? It's a long-term lease, not a lot of upside, not a lot of downside, very stable in a core market. So this is your risk return, and it's really important to understand when you're doing ground up development, you are playing at the top of that curve. Regardless of what anybody says to you, that's where you are. You have dead body risk, you have entitlement risk, you have lease up risk, you have the most amount of risk in any type of development that you're doing, regardless of the market. But here's some reasons why I personally love. We're going to go into the ground up side first and kind of compare the two. But why I love ground up development is because I'm building stuff and I have a blast. This is me and my wife, my kid. I took to the project every Saturday to walk through. She loved coming out there in her different dresses and things like that. But getting back to seriousness here, there's value in the land that you buy. You can buy land grossly under market and make money when you buy, and then there's a challenge, right? It's like brain damage for a long time, but you can go through some really challenging permitting situations and come out successful with a very valuable piece of property. Usually when you develop, you're doing it in strong demand areas, so high market rents, high demand, underserved markets. And you can get really creative on how you finance these projects, which I really love to do. It's kind of what I'm passionate about in real estate. And then optionality, we're going to talk about that in a minute. And then you build what you want. You're not taking over some mom and pop thing and you're wondering why they did the unit mix the way they did, or you're trying to kind of move stuff around and make it your own. You build it from the scratch, and you can build a beautiful property in doing that. So this is a property we took from raw land, and we got all the permits, entitlements. There I am out there when first day we broke ground, and we built a beautiful Class A facility just outside of Seattle, Washington. That's going through its lease up today. And really what's involved in this project is, the entitlement risk is your first step in the risk. So when you understand that when you're doing ground up development, the first risk that you take on is the entitlements. So can you get the permits? Do you have the right zoning? Do you get the site plan approval? Things like that. And once you get those entitlements done, the property jumps in value because now you have a fully entitled shovel-ready site for someone to come in and turnkey and take over and build. The next step in the risk is the raw land development, getting the contractors out there and building your site, right? And that could be sold at certificate of occupancy. We'll talk about that. And then once you get it built, you can sell the property or you can lease it up. These are 3 pictures of the property that I just showed in the previous slide that we built. You can see we built a beautiful office, great monument sign, and really nice unit mix of drive up and interior storage. And what I like is the optionality, like I talked about earlier. You can entitle that land and sell it. You can sell it at certificate of occupancy, or you can sell it when it's leased up. And what that really means is it gives you these 3 options, right? So you can acquire and entitle the property and sell it within a year or two. Or you can get it to certificate of occupancy, or think about it that as your grand opening, like right the day you open with no customers, there's a strong market for self-storage, particularly where you can be sort of a merchant builder and you're just building these things and then handing them over to a REIT. And that can have a great return projected to the investors as well. Or you can buy it and you could do what we do, usually slap the free up storage team on it, and then we lease up the property and it becomes even more valuable because it's income producing at that point. So really 3 nice options in ground up development that you don't get in the existing facilities, like in the income fund, right? Because you're just buying it all baked out, right? There might be some value add, which we'll get into that, but you're not having this optionality early on in the project. Both existing and development deals, they all need to have the same demographics. There's really isn't anything that we wouldn't do any differently if we were going to buy or build. Obviously, if we're building, we need those market rents to be, $18 ideally or higher per square foot, like we talked about. But we're looking for all these trends, regardless if it's existing or development. So let's talk about on a ground up development yield to cost. This is a really important number, and when you're looking at a ground up development, we've sat down with some of the biggest institutional shops out there looking to place capital into ground up developments, and they typically want to see an 8 to 12% yield to cost. So when you're looking at your project, you have to say, what is the total net that I'm going to pay to build this property just to get it to where it's stabilized? And so on a storage deal, typically you're looking at anywhere from a $9 million to a $17 million total project cost. And that considers things like how long it's going to lease up and how much money you're going to lose and things like that, because you're going to have to lease it up for a certain period of time. You take all those costs and then your expected income from when you're stabilized, and you divide those two numbers, that's your yield to cost. You almost could think about it as a cap rate to get the facility to stabilization. And so in development, you can see why an 8 to 12% yield to cost is super important for today's environment, right? You want to make sure that it's high enough to where when you build the property, maybe you're selling it at a 5.8 cap and divided by that same income. Now you're looking at about a $19.6 million value. And you can see the value that's created now, right? A Class A facility right now is, trading at probably sub 5 cap, but again, you're being conservative. You're saying, hey, I'm going to sell this for a 5.8% cap when it's stabilized. And based on the income it produces at stabilization, that would be a $19.6 million deal. Now, you want to do the math with me. You just take 0.0948 multiplied by 12, right? And that tells you how much net income that this facility is going to produce. So if we do that together, you take 0.0948 times 12 million. So 11 or 1.137. That's the annual NOI stabilized. Now, if they're going to sell it at a terminal cap of 5.8%, you divide that number, that NOI number, that 1.137 by 0.058, and that gives you the value of when it's stabilized. I can see if I can get there, 19.6 million. And that's how you can kind of quickly understand a deal, right? How much yield to cost, and then what is the terminal cap that's going to derive the value of the facility. And then that can kind of prove out to you that that deal is going to make sense. So I just wanted to spend some time there. So contrasting that with the income properties, right? Existing properties have the three things that every investor wants: cash flow, upside, and depreciation. So, obviously we'll start with cash flow projections that you want to look at. This is what we produce on our income fund or project on our income fund. You want to kind of understand, when does the cash flow start? Does it take 90 days to start? When do my funds go active? And when are distributions issued? And so those are some good questions to ask. This kind of gives you a projection of what the cash flow would be on an income fund. So if you put $100,000 in, it'd be as follows, right? 4 to 5,000 in the first year, increasing thereafter up to year 5, and total in the deal, you'd be getting about $28,000 to $35,000 in cash, or about $333 to $666 per month. So it's important to understand what those cash flow projections would be on an existing facility. I love existing properties. Again, mom and pops really let them go. This is our strategy to buy these properties that haven't been well positioned. This is a property we bought that we're about to sell actually in 2019. And the operator wasn't doing a very good job of advertising and signage and things like that. There was a tree growing out of the building, as you can see. And sometimes, if you could see here, that property, I always laugh, that's in our Tyler Longview portfolio. It doesn't even have a sign, right? So you don't even know what it is. That last property that I showed actually didn't even have a working phone number. And when the property inspector came to look at the property, it wasn't on Google, so he couldn't even find it, right? So that's like an easy value add. So I love that kind of stuff. Cars sinking into the parking lot, just kind of run down things looking at that. And, and then we look at the signage, right? Like, Are you a mom and pop looking signage, or are you a brand that people can kind of trust to have a safe and secure site? So these are kind of the value add existing strategies that can really play favorably. We go in, maybe we just do a light refresh of the office instead of having to build an entire building and build an entire office. We can just reposition these to great looking retail space. We make them safe and secure, and we do that by lighting the drive aisles, good cameras on the property, et cetera. But I wanted to open it up for questions. But if you wanted to download our ebook on this, how to evaluate a sponsor, basically how to do due diligence on a sponsor. I wrote a book on it, a little ebook, which I think is well put together, well thought out. But you can download it by going to that QR code, and you can go on our website. You can download our how to evaluate a sponsor. Maybe I can follow up with Ryan on getting the book, but it really has some insightful things: how to find operators, how to get educated, some good questions to ask operators when you're getting on the phone with them, et cetera. But that kind of leads me to the end. You can do your due diligence on these funds. We have 3 funds that we offer. So part of doing your due diligence is defining your criteria, right? Maybe you're a risk high yield investor, and growth fund is better for you, and you do your due diligence, and that's what you want to do. Or you're more cash flow, or you really want the security of maybe a debt fund. So these are the 3 different options that we have. I encourage you to do your due diligence on us and any operator that you're investing in. I'm very passionate about that. And with that, we've got about 10 minutes or so for questions. So thanks for listening, and yeah, I guess we'll open it up, Ryan.
Yeah, great stuff, Ryan. This is very, very good. Very good information. I know we get questions about just underwriting a deal in general from the community a lot. So a lot of value here. We really appreciate that. So no questions in the chat right now, but I see James has got his hand raised. So James, I'm going to see if I can unmute you, and then we've got another one also. So James, if you're
Awesome.
able, go ahead.
Yeah. Hey, thanks, guys. Thanks, Ryan. This is fantastic. Some of this information here, way you break it down for us newbie passive investors, is phenomenal. So thank you very much for taking your time to do this. You talk specifically about, underwriting a deal on a given property when you showed the pro rata on that, and you guys are offering funds, and there's other operators out there that are turning towards funds in this model. And obviously, when we go down that path, we don't have the opportunity to underwrite every single property, right? Because we're investing in the fund. So maybe if you could just lay out, I don't know if there's such thing as underwriting the operator, but if there was, maybe some of the things that we could look for in an operator that would kind of underwrite who they are. And I appreciate your time and answer on that.
Yeah, great question, James. I love that question. My book that kind of dives into that, but I will just answer the question here too, which is I actually encourage people, don't even look at deals, look at the operator and go underwrite the operator. And the way that I would do that is, it all starts with the interview, right? So you're getting the operator on the phone, and you're asking better questions, right? You probably have a list of questions that you ask, but I say ask better questions. And, and that's really, I'm an LP in like 12 different deals or whatever, but in addition to my own, my thing is like, how do you get more information out of those calls to really kind of start underwriting that operator? And so one of the things that I like to ask is, tell me about your worst deal. And then I say, well, and then I immediately follow that with, how did that deal go? Like what did, how did the communications happen during that time period? And then maybe I'll ask, okay, well, thank you for sharing all that. How often do you guys communicate? Oh, I communicate this often. Okay. And then at the end, I say, hey, can you send me communications about that deal gone bad? And how, and now you're kind of checking the actual facts, right? Like, oh, okay. So now I'm seeing how they're interacting with their investors when things are going poorly. So that's kind of one thing, because that's the worst thing out there is I think investors complain about the most. Communications, right? And sort of understanding what's going on is the big thing. So it depends on what your needs are, but that's one way I do it. The other thing I do is I love property tours. I want to go walk a property with an operator, and I want to hear what they're saying about how they add value and where they are in the process of that particular property. You know, that might not always be possible, right? I get it. You're live in different states and they might not have a property in your market. You don't have the time. But if you can, to an extent, I would really like that. I also like, you know, getting references that they didn't give you, right? And I think that's what I love about the LFI community is like basically it's this ecosystem that has a forum and it has ways to connect with people that the operator hasn't given you as a reference. And I think that's really key. And what I usually try to ask is, you know, give me a reference, and I always try to like box it in. Give me a referral of an investor in your worst deal, right? And then you can ask good questions about, hey, how'd this deal go about, and why did this deal go so poorly, right? So now you know they already told you what their worst deal was. Now you have an investor in it, so now you're connecting the dots, right? Are they being honest with you, right? Then I say, hey, give me an investor to talk to. I always ask for 3 references. I don't think that's unreasonable. I think some people think I'm too unreasonable in this, but I don't think it's unreasonable at all to ask for referrals. I don't think it's, I mean, you're investing hundreds of thousands of dollars potentially, right? The other thing is I would say, let me talk to one of your investors that has invested in multiple deals, right? And then that's kind of their champion. That's probably somebody they really want to give you, right? And then ask for somebody who's only invested one time, right? They invested once and then they disappeared, right? And then you can kind of dig into that, right? So then, and then you can fact check that with the investor, right? When you're on, oh, you only invested one time. Well, why did you only invest one time? Not, you know, not, you know, um, and so that might be a good way to sort of get good information, ask really great questions. As far as underwriting deals into a fund, it's all about understanding what their buy criteria is and look at their track record of funds, right? Did they, you know, okay, we did fund 1 last year and we said it was an income producing fund. What did we buy? Right. And you can look at all the deals that we bought and you can say, okay, those all landed in your projected buy box, right? You aren't out there buying some weird obscure property and throwing it in there, and understand what they can buy. You know, some funds are income funds, but they can have an allocation to ground up development, which would cash drag, right? But it might be limited, or they might say no cash drag. So we put out individual property underwritings for our funds, but you know, and then that way every investor can know, like, why did we buy this and why do we put this in the fund? And I think having that experience of the operator, even though it is a fund and they can kind of have discretion on what they buy, really understanding what they buy and what they bought so that you can kind of evaluate if you want to invest with them again. I hope that answers your question. I kind of was
Yeah,
all.
that's fantastic. Thank you very much, and thank you for these informational sessions.
Yeah.
From one pilot to another, it's pilot proof. So I
Awesome.
appreciate
Oh,
you.
what do you fly? What do you fly?
A320.
Well, oh, really? Okay.
Yeah.
Awesome. Well, I have a podcast. Sorry, Ryan, I'm going to shamelessly plug it. It's called.
Yeah,
I was
I'm
gonna let
listening to
Go
it.
ahead.
Oh, you are? Okay, cool.
Yeah, you and Tate is
Yeah,
what
me and Tate.
yeah.
It's called Passive Income Pilots.
Yeah,
So,
just started listening to it. I appreciate all the education you're putting out there for the
yeah.
community, and keep doing what you're doing.
Thanks, James. Appreciate it.
Yep. I was gonna let you plug that. I remember talking about it at BEC. So yeah, I'm glad you brought that up, James.
You know, yeah, me too. I should have had it in my little picture photo. So
There
you
you go.
always know there's a pilot when in a meeting room because they'll tell you, right?
Yeah, yeah.
It's a bad joke.
All right, we've got one more. DB, let's see you had your hand raised. If you're able to talk, go ahead.
Yeah. First of all, thanks for sharing this, Ryan. Very, very helpful. I think the reason that you don't see any questions on the chat, it seems like the chat is disabled, at least for me.
Oh no. Okay.
Oh,
Yeah,
thank you.
I
I'll open
can't.
that up while you go ahead with your question.
Yeah, my question is actually, what do you think about third-party audited financials? Like, this is a question I ask many sponsors. Like, do you do
Yep.
third-party audited financials for the past year? And if yes, can you share? What I have observed, at least so far, is that actually not many operators actually do that. But is that a big yellow flag if people don't do that? Like, what do you think about these priorities in vetting a sponsor?
Great question, man. This is awesome. I love good questions. Yeah, actually, we're looking into it right now. So we plan to have audited. This is a projection. We haven't formalized it yet, so I want to make sure that's disclaimered. But we do plan to have audited financials for our funds going forward. Is it a red flag? I don't think so. I think 95% of the operators in our little ecosystem here are not audited financials. It's very expensive. And I don't know if a lot of shops are set up to do it. we're really scaling and growing, and so it's just natural. We're getting some really big check writers, and they want audited financials.
Hmm.
So while we're not required to do it, we're moving in that direction, and we're looking into it as we speak. So I wouldn't be surprised if we don't have that rolled out by the end of the quarter, for our investment. Um, I don't know. I don't know enough about audited financials, to be perfectly honest with you, to unpack the value that it's going to provide to you. Um, either way, I'm sure it provides some type of assurance and value, but I'm not sure how bulletproof it actually, it is. So, um, more on that to come. But yeah, I have heard of some of the investors that I invest, or sponsors I invest with, are doing audited financials now. So we want to jump on that bandwagon.
Great. Thanks for sharing your thoughts.
Yeah, you're welcome.
Okay, and just for clarification for those on the recording, uh, Daniel had asked if the investments are open to accredited investors only, and Ryan answered in the chat, yes, available to accredited investors only. So thanks for that question. I believe the Q&A is open now. So if anybody had a question that wasn't able to submit that, please go ahead. I don't see James, I see you've got your hand up again. If you would like to ask a second question, go ahead. You should be able to.
No, I'm sorry. I just didn't put my hand down.
Oh, no, you're good. You're
Appreciate
good.
it.
All right. Sounds good. Well, we've got just a couple more minutes. Couple questions. And while we're waiting for any others that are coming in, Ryan, you had mentioned, a checklist for passive investors that they can use. And would you kind of suggest, and maybe it's specific to self-storage, but you had gone through your 5 bullet points that you really analyze, and why would you suggest that, especially for self-storage, that those are kind of the bullet points, and maybe even across asset classes, that those are really good bullet points to check?
Yeah, that's every asset class.
Yep.
Obviously, the EGI, right, and the cap rate is going to be kind of asset centric. So doing a little bit of research on what's expected in that space is important, right? I mean, some people might be like, man, you guys are buying 6 cap self storages. It's like, my buddy's buying them for 10 caps. It's like, well, your buddy's buying them in the middle of nowhere, right? Or they're buying the asset quality that's low. So it's really important to kind of understand the context in which you're reading. And I think that's important to, to really look at in a deal. And also, a 5 cap might have a huge value potential that is not really, you got to consider that in that. So I say those 5 items are things that I like to look at, regardless of the asset class type. So.
Okay, great. And I would agree. Those are, and you did a really good job of explaining that those are, especially on the expense side of the P&L, those are the expenses that you can't control. So
Yeah.
Looking at the assumptions that are being made there is a great point. Great discussion on cap rates too. I think that's a misunderstood, and like you said, 10 cap versus a 5 cap, and why, and then going through your progression of the understanding of cap rates and different types of cap rates. Great discussion there. I think that's always a misunderstood topic, and up for much debate, but very good discussion on that too. I appreciate that.
Yeah, no problem. Yeah, it's funny. Like people were like, "How can you buy a 3 cap?" It's like, well, you can redevelop the property, and then it's And I always laugh. I'm like, you realize all ground up development, it's like a negative cap rate. I mean, you start off, you're buying something that doesn't produce any income, so you're buying a negative cap rate, right? So when you kind of think about it that way, you just kind of scale it the other way and say, well, how much value upside is there so you can buy it at a low cap? I'm not suggesting that you go out and buy low cap rates. I'm just saying consider the variables, right? So
right, yeah. Absolutely. Well, we want to be respectful of your time. You've given us a full hour of a lot of valuable information. So I don't see any more questions in the chat, but I think there's a lot of stuff to unpack here. So it might even be worth a rewatch for everybody who's even been on the call. There's a lot of good information in here. So Ryan, with that, we'll direct everybody here to Spartan Investments, Spartaninvestor.com, Spartan-investors.com, if I can get that out right. And then Ryan's email, and also the QR code for the value added sponsor book too. So really appreciate all the value you brought today. And this will be out for recording if you missed it or want to go back and listen to it. Otherwise, thanks everybody for joining us today. Thank you, Ryan, for your time, and we'll see you again next time.
You're welcome. Catch up with you guys soon.
Thanks, Ryan.
Bye-bye.
Bye.